Hello, chart watchers, and welcome to this Tuesday, March 20th Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we tried to get off to a good start today following yesterday's bloodbath. The Dow Jones continues to hold on to a 107-point gain, but the S&P 500 has just turned fractionally lower, while the NASDAQ and the Russell 2000 follow suit to the downside. The 10-year Treasury yield got up close to 290, hit 289 earlier today, but it is backed off just a tad, sitting at 2.88% right now, up about 3.5 basis points today. Volatility index was down earlier, but it is starting to recover with the market's weakness. And right now we are seeing the VIX up 13 cents, which is just under 1%. Energy, I wrote about this in my blog this morning, but the XLE trying to make a little bit of a comeback. We've seen crude oil prices rising recently, but the XLE really hasn't followed suit, trying to play some catch up today. Oil services, you could see after going down back in the latter part of January, early February, really in kind of a bear flag pattern, but is working its way back up today, having a very strong day, up over 2% and approaching some key resistance. The XLI also was having a much better day, but still up today, up about 0.43%. Transportation services leading the industrials to the upside. Still a lot of overhead work to be done here on this group, though. Internet stocks still in the news today, and today it's Twitter having a really rough day, down more than 9.5%. I'm going to go over that chart in a bit. Facebook, really big breakdown today, below 170. This is one of the weaker links in the internet space, and this is dragging down a lot of the internet stocks. Facebook down another 5.6% today, almost $10 after yesterday's bloodbath. And again, we'll take a look at that and Twitter in just a few moments. But first, let me bring in my co-host, Aaron. Aaron, how are you doing this Tuesday morning?
I'm doing quite well this Tuesday morning. I'm wondering if one of these days when you ask me that, I'll just be, oh, terrible. It's terrible. Having an awful time.
You said it.
But no, I'm really not. I'm always pretty positive. So,
well, you said you're getting rain in Southern California.
yes. And we actually like it when it rains because it doesn't do it that often, but nobody knows how to drive in it. I always stay inside, not to get wet and not to face all those crazy drivers on the freeway.
Well, I grew up believing that it never rained in Southern California, so I guess that was not true.
No, it does now and then.
Okay.
That's how we keep the palm trees green.
There you go. Well, I know we've got Mr. Shelby coming on here in just a couple of minutes. How are you doing, Bill?
Good. How are you going?
I think we're doing great. We're looking forward to your presentation. It's always nice to get some tips about stock charts, so we're looking forward to what you got for us today.
Yeah, we'll go over something new today.
Awesome. So Bill's going to come back with us here in probably about 10 minutes or so, maybe just a little more than 10 minutes. But first, I'll let Aaron go through our announcements and our agenda, and then we'll get going.
Absolutely. This week, we're going to have David Keller. He's a CMT. He actually was the managing director of research at Fidelity for quite a while. So he's going to have some interesting things to talk about, I suspect. And then we have on Friday, Tom's workshop, Reasons to Sell. So it's easy to figure out how to buy, but now you're going to learn a little bit more about how to sell. And that's it for the rest of the week. Should be fun. And today we're looking at everything stock charts with Bill. He is here, as we were saying. Then we're going to do a segment, drilling down, followed by our 10 and 10 to 1. Our first symbol is going to be Twitter. So if you wanted to go look at that chart, if you haven't already today. And then finally, we're going to end with actually, I think we're going to be doing a sector rotation. So we didn't switch that, but that's okay. So sector rotation to finish out the day. And with that, let's pass this on I'll pass it back to you, Tom, for some technical news.
Sounds good. First, let's start with the 10-year Treasury yield. No economic news out this morning, but the Federal Reserve did start its two-day meeting earlier today, and they will be out with their latest interest rate announcement and policy directive tomorrow at 2 p.m. Eastern Standard Time. So I suspect the market's going to kind of remain a little bit apprehensive in front of that announcement. Just about everybody, I think, is expecting a quarter-point rate hike. So I don't think that's going to be an issue, but I think everyone will be focusing on what the Fed has to say, especially about expected growth, and about maybe inflationary expectations as we move forward. I think that inflation, that big I word, I think a lot of folks are looking at interest rates as being the big key, but I think it's more about inflation. So it'll be interesting to see what they have to say about their inflationary expectations throughout the balance of 2018 as we move forward. But you can see the bond market right now with Treasury yields just kind of continuing in this range. Who knows how long this consolidation goes on, but you can see that the PPO here on the TNX has worked its way back very close to the center line. We did this once before. We were in an uptrend in the TNX and kind of settled down. We had a negative divergence. Here was your higher yield. Here was the lower PPO, and we settled down in this sideways consolidation. PPO worked its way down to the center line, and then the trend continued back to the upside. I think we're seeing something very similar here with that negative divergence on the high, higher yield, lower PPO at the very top. And now here we are working our way with the PPO moving back toward the center line. So I expect further consolidation unless the Fed comes out with something that just blows everyone's mind tomorrow at 2 p.m. I would suspect we'll continue in this range, at least in the near term, and then we'll go from there. But with the interest rates potentially being increased tomorrow and with the more Fed speak, I like to keep my eye on what's going on with some of these interest rate sensitive areas of the market. And perhaps the biggest one for me is banks. Banks do well. I know from having worked in public accounting and I audited banks for many years. Banks tend to do very well when interest rates are on the rise. And so if we go back and we take a look at a longer term chart, we've been rising, had these interest rates that have been on the rise for a while, especially starting back in November. In fact, let me switch over before I talk about this chart. Take a look at the TNX on this 3-year weekly chart. And you can see we bottomed in July, but really starting in November is when we had a huge spike in the yield. We consolidated, then broke out again. As rates move higher, banks make more money. And as long as the economy is strong or continues to appear to be strong, loan loss reserves tend to stay close to a minimum as well because the economy's strong and they don't run into as many bad loans. So here's your 10-year Treasury yield back in July, bottoming and moving higher. Now let's take a look again at those banks. And you can see that really from June is when we started to make a big move, but the biggest push started in November of 2016. So as long as the yields continue moving higher, I would suspect we'll continue to have very strong performance in the banking area. So again, unless there's something that comes out of this Fed meeting tomorrow that's unexpected, I would look for the banks to continue to do well. And on this weekly chart, by the way, as we kept moving higher, you can see the weekly PPO continued to move higher. And all we've done is just had these ordinary 20-period tests, or in this case, 20-week tests on pullbacks. So I think the banks still look very strong technically, and I would not be surprised to see them make a run once we get the Fed announcement back behind us. And as I mentioned yesterday, Greg Schnell and the chart watchers over the weekend did talk about a number of the smaller banks. And so you might want to go back and take a look at that article as well. A couple of other areas within the financials that I think are worth keeping in mind and watching. Life insurance also tends to do pretty well with rising interest rates. Now, you can see the volume really picked up at the end of January and early February on the selling. And that's a little bit unnerving. We haven't been able to get back up above that 20-week moving average, but I would watch that 20-week because I think if we climb back above it, I think it could start the next leg higher in life insurance. On the pullback, while there's been a lot of volume and we did fail to hold a couple of key moving averages, we didn't have a problem holding on to recent price support. So yes, the price came down, volume was heavy, but we didn't lose support. So I would continue to watch 750 to 775 as major support, longer term support on the life insurance index. A couple of others within the space. Let's take a look at the investment services, the DJUSSB. And with this, you can see we have been moving higher. Notice back in, I guess it was in February of 2017 when we put in the higher highs and we had the lower PPO. Notice we went through several months of sideways consolidation. We never got to the 50-period test and we never quite got to the center line. But you can see that led to a lot of frustrated traders throughout this period as the investment services group went nowhere. But since going through that consolidation, we have been stepping up, higher highs and higher lows, holding the rising 20-week. But we are now just recently, we did break out with a lower PPO. So this is a group that if we don't get the news we want from the Fed tomorrow, this is one that if the financials pull back, could be susceptible to maybe a little bit more selling. It's something that certainly keep in mind as we move forward. And then finally, the asset managers, DJUSAG, very similar, continued to move higher, except on the most recent high here, check out the PPO. It was higher, and these pullbacks have been holding on to a rising 20-week moving average. So 4 different industry groups looking kind of different, each one of them, as we consolidate with the 10-year Treasury yield between that 280 and 295 area. I think if we do break out, though, on the yield, expect all of these financial groups to do extremely well going forward. I mentioned Facebook and Twitter, so let's take a look at Facebook. First, just on the chart, you can see that the last 2 days of selling, check out the volume today. We have 35 minutes to go to the halfway point of the day, and Facebook has already traded 73 million shares, and it was a gap down and continued selling. We've pointed out, and I pointed out in my blog today, Facebook's been holding this 170 level. We've had a couple of dips into the 160s, but we come right back up. Yesterday, we tested 170. Today, we actually opened beneath it. So unless we have a strong recovery this afternoon, I think Facebook has really taken a turn to the downside. And I think Bruce Frazier, if he was here, would agree with me. I think Bruce was the one recently that mentioned he thought Facebook was starting to turn much more negative from a Wyckoff perspective. And now we're starting to see the volume confirmation and breakdown distribution that Bruce talks about. And I don't want to put words in his mouth. Next time he comes on, we maybe talk about Facebook. But this one does look pretty weak to me. And if we pull up that relative chart, I want you to take a look at Facebook and compare this to Twitter, which I'll show you in just a minute. Here's Facebook. As we were moving higher, the internet index was moving higher. So we're breaking out. Facebook on this chart looks pretty good so far, right? Well, let's go down. How about Facebook relative to the index? So here's the index going higher. Here's Facebook going higher, but you don't really see the relative weakness until you pull up Facebook relative to the internet stocks. Here you can see that we have been declining. We actually topped on a relative basis all the way back in September of 2017. And Facebook on a relative basis to its peers has been declining and really struggling over the past 2 days. Here you can see that Facebook relative to the S&P 500 began to break down back in November. That was the high. And we have slowly been working our way lower. And with the selling yesterday and today, we are now working our way back to probably about an 8 to 10 month low on a relative price performance basis, looking at the S&P 500. And then at the bottom here, you can see the internet stocks. So we continue to move higher, but we do have periods, this is one of them, where we have seen some pretty big selling only to see the group bounce back. I think Facebook is maybe an exception to the rule as opposed to leading the entire group lower. I think that some of these other stocks are being dragged down with Facebook and probably will come back to life here shortly. But I am worried about Facebook. Twitter, let's pull this one up and take a look at this on a relative basis. Same industry group. All right, so Twitter has been moving higher. Notice that in March here, it actually moved to new highs above the February high that it set with earnings. And you can see again, here's the internet space continuing to move up, but internet never made a breakout to higher highs. Twitter did. So that's a positive. Twitter relative to its peers just before the selling the last couple of days was at a high. So this stock on a relative basis has performed very well versus the internet stocks in total. And then here's Twitter versus the S&P 500. It actually blew the S&P out of the water for about 6 or 7 weeks and now is giving back some of those relative gains. And again, here's the internet stocks relative to the S&P. But the key for me is this right here, where Twitter has actually been a relative leader in the internet space and a relative leader versus the S&P 500. And therefore, I think the pullback is likely to create some opportunities for Twitter. I want to go out to the weekly chart and just show you Twitter here. On the weekly chart, you can see the move to the upside. We had some resistance at about 25. We broke out above that on very heavy volume. And now the 20-week moving average, as we come down, we haven't even seen a 20-week test, which would be down at about 27.5 to 28. So I could see a little bit more weakness here on Twitter But I think the lower it goes, the better the reward to risk gets, because I think we're going to go back up eventually and test the recent highs on Twitter. So this is something to keep in mind. XLE, actually, before I get into this is going to be the last thing I want to touch on here. Let me go into the blogs rather than recreate the chart. And there was a chart that I put in my blog this morning showing the XLE and crude oil prices. So let's take a look at that. All right, under the sector industry watch, here it is. So here's the XLE trending higher, pulled back, trending higher again, putting in the higher highs. And then you look at crude oil doing pretty much the same thing, although crude oil here hasn't really fallen much since its recent high. It's fallen a little bit, but not to the extent of the XLE. So I think that this is a group, or maybe a little bit of a inverse correlation that has begun. You can see that the correlation between the two have been dropping here in 2018, but normally we have very tight positive correlation between the two. So my question is, and crude oil prices are up again nicely today. So as long as this uptrend continues, you would think it's only going to be a matter of time before the XLE begins to turn with it. And if you click on the charts in the article and then click on the live version, you'll see what's happening today. And the XLE right now is at 67.24. Can't really see it on this chart, but if we pull up a daily chart, you can see the XLE having a pretty nice day after testing price support down around 66. And this has been a key area of support on the XLE. I'm going to say 65 to 66 is a really important level on the XLE. We're bouncing off of it. Need to get a close over the 20-day, though, before we're ready to really rock and roll here with energy. And with that, I am going to turn it over to Bill Shelby, who has another stock charts tip for you today. What do you got for us today, Bill?
All right, guys, I think today we're going to go over MarketCarpets. I guess from the poll that not a lot of people are aware of MarketCarpets or have seen them. So we'll go ahead and do a little bit of a presentation on that, show everybody how they work, how to find them. There's different modes. We've got the public groups such as the S&P 500, the Canadian S&P, and a number of other ones, as well as your own chart lists. And we'll go through all the features, and there's a whole bucket load of dials and switches to play with. So we'll go through all of those, and then we'll just cover some of the metrics that we can track on the market carpet. So we'll head over to our control center here, over our extra control center, your pro control center. You can scroll down and select our market carpets. And you can see from the beginning there, we've got a whole bunch of colors and different sizes of boxes, and we've got different segments within the box. This is a market carpet of the S&P 500. So you can see these large roped off areas here are the individual sectors. You can hover over a particular item. It will show you that the percentage gain in price over the time period, as well as the percentage gain of its sector. So you can see that we've got technology, all the 9 sectors here. Over on the right side, we've got sort of a mini chart of each individual item. If you click on an item, it'll change the mini chart. We've got a list of the top 5 in terms of percentage and the bottom 5 in percentage. And you can see over here, when we're not hovering over them, you can see the -1, -3. A bunch of our gainers over the last couple of days have been in energy. Interesting. We've got the ability to go see another chart, one of our familiar charts, such as a point and figure, the perf chart, or the sharp chart. We've got our date control that's similar to the perf charts and the seasonality. So we can take our chart time period here and drag it through time and see what changes. And we can also expand the time. The default time is 2 days, which I find a little bit narrow. So I often like to drag this out to maybe say a month, about 20 days. So that gives us kind of an idea of what's been going on over the last month in these areas. And you can then scroll through these time periods. And what it does is market carpets are also seen or known as heat maps or performance maps. So you can very quickly get an idea, in this case, if you're the S&P 500, of which sectors are doing relatively well and which ones aren't. I mean, here, obviously, utilities over the time period from mid-December, late December to January, clearly was an outlier, not performing very well at all when everybody else was pretty much doing okay. And you can see as we move on, we're starting to hit a rough patch here. Everybody's down in this mid-January to mid-February time frame. And then we've started to come back, had some good periods there, and now we're sort of mixed. So it's an easy way to take a look at a whole bunch of stocks and kind of get a feel for how well they're doing in the aggregate. As you can see, we've got our floating little dialogue there. We right-click on this, and we get all sorts of options. We can do an animation, which basically does what I just did, but automatically scrolls through the whole time period, and we'll repeat. We can hide this little info box if we find that a little bit annoying. We can also make it fixed over here in the bottom area, so it's in one place. As we scroll over, you can see the symbol. But if you'd like to see them all, you can turn them on in mass. You'll find that with these larger groups, there's 500 here, certain options, when you turn them on, will get very visually busy. So you just kind of have to decide how much noise you can tolerate there. If we don't want the bottom 5, they will turn off there. That means the numbers here. You can see the 5s, -3, -4. We can toggle those on and off if we don't care about them. By default, you'll notice the squares are different sizes. Their sizes are based on market cap. So we're going to have the big guys taking up most of the space: Amazon, Berkshire, Boeing, Apple. And then you get down to the little tiny guys, and you'll hear all sorts of companies that you may or may not ever heard of. Those are all, again, based on market cap. But if you'd like to take a more even view, you can turn on square mode, which is essentially everybody gets the same size. And this is sort of the equivalent of looking at equal weight ETF instead of a market weighted ETF. And there again, you can get a view for how the sector is doing in general without worrying that Amazon's the only thing holding up this sector, or Apple. We'll go back to market cap mode. Say we've got our top 5, bottom 5 over here. We can click through and get our mini chart over here. If we don't want that at all, we can hide it completely. We've got our date range up here for what our 20 days in this case represent. If we've got an up arrow here, so we were talking about, or you will be talking about after myself, this drill up, drill down. We can do the same thing here. So we can go up a level and look at the sectors as an average over a time period. And if you'd like to think of it this way, you can, I know Tom looks at the sector summary table all the time. Well, this is sort of a different visualization of the sector summary table. This is a 1-month view, and we can see based on color, instead of ranking in the table and our green or red bars, how everybody's doing. Where it differs is that we can make slight changes to the dates here that we can't make in the sectors table. So we can change this, say, well, I don't want to know the past month from today. I want to know the past month from 4 days ago. Or for some reason, maybe I only want to know 18 days. So this is a little bit more flexible than, say, a markets or a sector summary page. And we can tweak it and dial it in a little bit more. We can go back down by either clicking the down button or just by double clicking. And if we want to go down again, we can double click and just take the industry or the sector by itself. And we can go back up to the full view of this S&P 500. We've got a number of options here. We've got the Canadian S&P. We've got a few different, our market summary page. If you're familiar with that, we've broken those down into a market carpet. And then we've got a few different groups of mutual funds here. So we'll go back to our S&P 500. And by default, we do price because everybody's pretty familiar with the concept of price change over time. But we have a whole bunch of other things you can use here. We can do the scooter. If you're into the scooters, we can, again, stretch our range. This will be the scooter change over time. But we can also, by clicking this delta here, toggle between the change over the 16-day period that I've got down here. Or we can go in just to an absolute mode. You'll notice in absolute mode, the date range button down here changes to essentially 0. So we're looking at a static. What is the current scooter for all of these particular items? Again, we can scroll through time, but it's a single data point of what is the scooter on that day versus the scooter range. We've got number of days up, days down. We've got all sorts of other technical indicators here, the RSI. Again, you can switch between absolute and the change over a period of time. Full stochastics. Again, most people are familiar with price. Also, if we'd like to go a little bit bigger, we can hit the full screen mode. That's useful presentations and whatnot. You can toggle that by this square at the bottom. And that's pretty much most of the features for the market carpet. What we'll do next is go to show you how you can look at your own. So if we go to back to the members, you can scroll down to your chart lists, and I created one earlier today that's the Dow Jones Industries, all of those DJUS symbols that Tom is looking at quite frequently. We can do a market carpet of those. And here you'll notice there is just one level. We don't have the ability in our chart lists to tier things, to create subgroups within a list. So everything here is going to be flat, so there's no ability to go up or down. And we're looking pretty much just at price here. So, but we get the same options. We've got our top 5 and bottom 5 over the last 2 days, but we can stretch this out. This particular one is great for noticing industries that they're doing quite well. This is the equivalent of if you go to the industry summary page. This is sort of a 30,000 foot view heat map of those industries. So you can again take your time period to whatever you'd like and roll it over time. Again, some people also use this as a screener. It's not necessarily the same as the scan engine, but you can see that if you were, say, looking for what's an area that I really want to be involved in or don't want to be involved in, over the last several days, we can see gambling is up a fair amount. We don't really want to stay in this industry. It's been doing fairly poorly. So we can use this view to sort of get an idea of where the really hot areas are and what the really cold areas are in the market. And that's pretty much an overview of the market carpet.
Yeah, Bill?
Yes.
You kind of led right into our next segment, which we'll get into in a little bit on drill down. But I find it kind of interesting. I mean, we didn't discuss this at all, but I am going to be taking a look at the gambling stocks. And so this is another way for folks to just kind of get a sense of what's taking place in the market. I mean, we've had Julius de Kempenaar on here. He's talked about the RRG. I know Aaron uses the RRG quite a bit here on the show. That's one way to look at rotation.
Right.
I think market carpet's another great example of how you can look at rotation. I use relative ratios a lot of times where I can physically see the chart, in comparing one sector or one industry group relative to another, that type of thing.
Yes.
And of course we have scooters, which can help, kind of streamline the process of finding some of the best performing stocks or groups relative to the others. And so I think the market carpet, this is an area of stock charts, I'll be honest, I haven't really used a whole lot, but I liked getting that refresher because it does reinforce another way to use stock charts to be able to identify relative strength and weakness over various time frames, as you pointed out. And the thing I didn't realize you could do, the one new thing that you just taught me, is that you can do it on a equal weighted basis. I didn't realize that you could do that by looking at, say, a particular sector. You could go within there and just check out on an equal weighted basis. So you don't have the big market cap squares, but you can actually see all of those little smaller market cap stocks that you really couldn't see based on market caps, all of a sudden with equal weight they appear, and you can get a much better sense of the breadth within a sector of what's actually performing well over a certain period. I thought that was really interesting.
Yeah, it's MarketCarpet isn't, as our poll suggested, it's not a lot of people have seen it or have used it. But it's like I say, it's another tool. Some people, if you're more into a visualization kind of visualizations help you better than, say, looking at tables like the sector summary tables or the market summary tables. This can be a great way to get a lot of information very quickly, and it's customizable. I think we go out to 60 days is our maximum. So some of the, that's about a quarter. So the summary tables will take you back further, 6 months or a year or possibly longer on other areas within the individual charts, of course. But this is a very nice. It's got a lot of interesting features as to how to quickly see how something's doing, and like you say, drill into where you want to spend a little bit more effort and time.
Mm-hmm. I liked your comment about being a heat map, because that to me is kind of what it seems like, what it feels like, where you can look at it. And of course, the dark green tells you what's really working, and the dark red tells you what's really isn't working.
Right.
And, I mean, if you're a value investor, you may want to look at some of these that are deep red. But if you're more of a momentum trader, then of course you're more interested in stocks that are actually have been performing well, and maybe are those dark or lighter green areas.
And I didn't go through all of them, but we have tons of different color schemes ranging from the mild to the hideous. And
that would be hideous right there.
Yeah, some of them a little bit too strong for my eyes, but but there's a number of different color variations there, of course, and but it's the same general concept, that it's sort of a continuum from the high end to the low end, and it's just a way to quick. And I know that you're very focused on industries, so you can create these chart lists of particular. You can create your own chart list for the sectors or the industries, so you can create some stock chart lists and then use this. One of the chart lists that I have is a list of, say, 100 of the top ETFs. Same sort of thing. This is an interesting one from the standpoint of just which sectors and industries, but I can't buy any of these things directly because they're just indexes. So it's interesting to say create a chart list with, whatever, 150, whatever, ETFs that cover various sectors and industries and groupings, and use a MarketCarpet on those.
Mm-hmm. Yeah, I was playing around with this while you were talking, but I just looked at my NASDAQ 100 chart list. So I've got all 100 NASDAQ stocks, NASDAQ 100 stocks in there, and just pulled it back to look, say, at the last 3 days, and just to get a sense of what's been leading. And of course, Seagate Technology comes up, which is up over 2%. Adobe Systems, which reported earnings not too long ago, very strong earnings, up 1.95%. But of course, bottom five, Facebook's right up there, minus 10%. So it's another way quickly, if you have a favorite index or you have a chart list that you've put together with your own stocks. Could be stocks you own, it could be stocks that you're just looking at, like a watch list. But being able to view them in MarketCarpet, it could be a time saver for some, depending on how you like to visualize things. Really good. All right. Were there any questions that you saw, Aaron, in the room?
Let's see. I'm looking. And could you move your mic just a little closer? Because you're a little softer than Bill and probably me.
Oh, wow. Is that better?
I think so, yeah. Yeah, I think so.
Great. I just shoved it in my mouth. So,
okay. The question, I think there's a couple of questions here, but I'm not sure if you kind of answered them. On the MarketCarpet, are the days actual days or market days?
They're all market days.
That's what I thought. And I think that's how I answered it in the chat room. How do MarketCarpets rank the industries with scooters in the MarketCarpet section? So they were curious how you do that with the scooters.
Okay, we'll go back here.
And then the colors, just, maybe a review of the colors and.
Sure. Go a little bit bigger here. Actually, well, okay, so we'll go scooters. So the first view within the scooter is this the amount of change of the scooter over the time period. So here we can see that Boeing went from an 89.2 scooter up to a 92.2. So it's a net change of +3 over the last 2 days. So it's been reasonably strong. Our top scooter, if I can, here we go, Dover went up 14. So this shows us the big scooter movers. We don't get a sense of the price from here because, of course, scooters are all relative. So it may mean that everybody else has gone down, but Dover went up a little bit. But if everybody else goes down quite a bit, it may have a large scooter. So it's often nice to look at scooter, but then you really do have to look at the chart. You can see over here on our mini chart when we click it that, yes, in the last couple of days, this thing has shot up. It's been quite volatile, but it's shot up and it's broken above this recent high. Still not up next to that high, but you can kind of get a view for what the scooter's been doing when looking at this little mini chart. There's our friend Facebook, is the winner of the down scooter over the last couple of days. And then we can drag this out and again move it wherever we like. The color scheme in this one is basically from dark green to dark red. The white is sort of flat. It's going to be very close to 0. And as you get slightly more green into the heavy green, you'll be going up the upscale, and then these slightly red variations leading all the way to the dark red for the most extreme on the downside.
And the sizes of the boxes are?
Those are still market cap.
Market cap. Okay.
Even if you're looking at the scooter, it's still the market cap. But of course, you can, like I say, we can switch that to square mode and then do this. So this is another, we talked about being a different view than the summary table. This is a different view of the scooter table. So if you look at the large cap scooter summary table, that's essentially what you're seeing here in just slightly different format.
Mm-hmm. Excellent. And then the final question, I think, was, can you set up your own default setting for the MarketCarpets? Is that a matter of...
Not yet. This will reset every time. So if you find this little info box following you everywhere kind of annoying and you wanted to permanently fix it over here, it switches every time you come back. So we haven't got this sticky yet.
Mm-hmm. Okay. I think that was the majority of them there. I think we got them.
Great.
Awesome. Very good job, Bill. Appreciate it.
Thanks so much, guys.
Yeah. Thanks, everybody, for your questions, too. That was excellent.
Yeah, it's always good to, there's so much information. I think probably everyone feels this way, that there's so many tools available at Stock Charts. It's a great, I think it's a great segment to have once a week because it brings up all of these different areas and different tools within the website. Some may look at it and say, well, I'd rather stick with relative rotation graphs, or I'd rather just look at the scooters, on the charts, or, maybe there's still going to be times when I'm going to like my XLY versus XLP relative ratio chart and so forth. But this is just another way to visualize what is taking place underneath the surface of the market. Because, if you want to just know what's going on with the S&P and the Dow, to be quite honest, CNBC will tell you. They won't tell you why from a technical perspective, whether or not to expect it to continue, but they're going to just give you the numbers. I think what you're going to find at Stock Charts, whether it's through the Chart Watchers, whether it's through all of our blogs, whether it's through Market Watchers live show, these everything Stock Chart segments, we're going to teach you how to look beyond just those headline numbers on the Dow and the S&P 500. So in that light, I think this was a perfect segment. Another great demonstration by our good friend, Bill Shelby.
Excellent. Yes, I agree.
All right. Well, it is time now to get into drilling down. And so in this segment, what we try to do, as Bill mentioned during his segment, you look at an index and you can't trade the index, but you like the index. So what do? How can you possibly move on and find some good trading opportunities? So in this segment, what we're going to try to do is show you how you can come up with an idea or concept and find some actionable trading ideas based on that. So what I'm going to do first, I'll go ahead and start. And I'm going to show you from the member dashboard As Bill mentioned, I like to go into this sector summary and industry group area. But here you can look, I can sort the groups, technology, cyclical, so forth. I've sorted it by scooter rank. So this tells me that the two strongest areas right now based on the scooter rank are technology and consumer discretionary. So I started with consumer discretionary. And I looked and okay, today so far, gambling stocks, this is going to be the group that I picked. Gambling stocks are 5th out of 23 consumer discretionary industry groups. If I go to a 1-week chart, gambling is the best performing industry group within consumer discretionary. If I look at a 1-month chart, gambling is 3rd. If I go to a 3-month chart, gambling's 5th. And if I go to a 6-month chart, you can see gambling is 7th. So as we look at shorter time frames, and again, I'll go back to like that 1 week, gambling seems to be picking up on a relative basis. So I like the overall consumer discretionary group because it is one of the top ranked sectors in terms of scooters. And as I zeroed down, I felt like gambling was starting to pick up strength again. And so that is my industry group. Now, actually, I can just click on this chart right here. And you can see here is the DJUSCA, which is the gambling index. Had a beautiful move back in January, pulled all the way back, gave back all those gains, held on to support, though, and is now broken back above. Here was your reaction moves to the upside at about 1,000, 1,010. But we since took that out. You can see with these two up days, cleared that resistance on increasing volume. And as we pulled back, you can see lesser volume. So I think gambling stocks are starting to look really interesting again from a technical perspective. So I'm going to go through some individual stocks that I think look kind of interesting within this space. So SGMS, this is Scientific Games. Now you look at the daily chart and I think, okay, it's come down, the reaction high, we haven't been able to break through, doesn't look that great. Support has been established, pretty strong support between 39 and 40. But I want to pull up a weekly chart because sometimes the short-term picture doesn't do it justice, and you have to kind of go back and take a look from the big picture perspective. Here, you can see SGMS, as it kept moving up in late 2017 and early 2018, look at the PPO rolling over. So we had some momentum issues. We had a huge run in SGMS, but we started running into some momentum issues on a price basis, and that has resulted in some weakness over the past 6 to 8 weeks, where the PPO now has worked its way almost all the way back down to centerline support. So this is kind of one of those that might even fall under like the momentum sleeper kind of a category where it's a stock that was outperforming for quite some time, but over the last 6 to 8 weeks has been very, very weak on a relative basis. And as a result, may be overlooked right now. But I think it's just gathering some strength before possibly moving higher. And if the gambling index moves up, then this is a stock I think that could go up with it. If I look on a relative basis, you can see here was the big move up on a daily basis on SGMS. We've been struggling recently, but internets overall have kind of been doing the same thing, a little bit of overall weakness. And as a result, we see that SGMS, after having a huge move up over the past 2 months or so, has been underperforming its peers, but did just recently get close to a key relative support level. And if we keep scrolling down, it's starting to make a move back up against the S&P 500. And look at, this is what I find most appealing to me. Gambling stocks relative to the S&P 500 are pointing up and starting to break out. And so when I see that, I mean, you can look back here. Here's a double top. We make a breakout, and you can see the outperformance over the next few weeks. Generally speaking, here, when we get this breakout above a pretty key area of resistance, you could see for about the next week to 10 days, very strong relative move. And that seems to be about what we're trying to do here. So I think the gambling area looks really good. And as a result, I'm looking at individual stocks. I think Scientific Games, especially looking back at that daily chart, if we could get this breakout up here above 47, 48, that would be very bullish. But in the meantime, if you really believe things are picking up, we had lower prices. Here is your positive divergence. Here's your 50-day test to reset. Now we're coming back and testing the rising 20-day moving average. This is actually an area I think we could be a buyer on SGMS looking for a breakout above $48. So that is one stock that's worth considering. RRR, and I'm going to go through these others pretty quickly. Red Rock Resorts, sideways consolidation, been holding support, actually came down, tested support today. look at the volume on the moves to the upside relative to the volume when it pulls back. I think this one's poised for another push to the upside and worth considering. TSG hit overhead price resistance. I'm going to go into a longer term chart here. But here you can see really struggled at $30 back in 2015. We just got the $30. I think that the weekly momentum looks really strong here on the PPO, but it's possible we get back and test that rising 20-week moving average. ERI, this one's moving up, but with a negative divergence on the weekly chart. So this one maybe, I'd be maybe a touch cautious with ERI. The last one I want to mention, WBAI, beautiful move up, long tail here. We had a false breakout trying to get through all this resistance, starting to pull back a little bit, but this is the highest scooter ranked stock within this space. Very heavy volume, left that long tail. I think that's the reason why we're struggling here. Maybe we just come back and get this 20-day test before another attempt at a move to the upside. With that, I'll turn it over to Aaron. What do you have for this?
All right. So I'm going to start at the sector summary, which is what you did, because I think that's your best bet here. Let's get over to the right place. So I'm gonna say we're looking for an intermediate term investment, and I want to know where's the best place to start looking for possible stocks. So I'm going to start with the sector summary, just like you did, Tom. And I'm going to select my period to be 3 months, because that's typically, for me, an intermediate term trade. We're looking at 3 to 6 months. So I'm going to look on the shorter term side and see what's going on. So right now we can see that cyclicals, technology, and financials are leading. I'm going to go ahead and do something that I don't regularly do, but I'm going to take a look at these 3 sectors seasonally and see what happens, because I know that's your space mainly, Tom, but I wanted to check it out for myself just to see because all 3 of them are really very strong. So I kind of wanted to see where everybody is seasonally. So here we go. So very nice, April, right? XLY, so we're looking at 2.4%, 68% of the time. So that's pretty good. Let's do the same thing. I'm going to do it for XL. What was the other one I had? XLK, technology. And I'm going to bring this out 20 years. April's not bad, 63% at 1.2. All right, okay. And then I'm going to do XLF and see what happens. There we go. Very nice, April. And we're looking at a little bit better of a percentage. So of the 3, I'm going to go look at financials. So what would I do first? So I'm going to go back here to our member homepage. And I'm going to go to our industry summary, because now I know I want to look at, actually, I'm going to go back to the sector summary, because I think this is the easy way to see it. So I'm going to go to the financial sector. And this tells me all the industry groups that are represented in that sector. And I'm going to do the same thing you did. Well, I can't do scooters just yet. So we're going to look at, I want to do this at the 3-month level. So what are the leaders here? Let's see, as far as percent change, specialty finance is sort of leading it. So I'll go ahead and take a look at specialty finance and see what we have in there. All right, quite a few. Now I can do it by scooter. So I'm just going to look at the top 3 or 4 and just see what we've got going as far as the, what the charts look like. So for me, of course, I'm always looking at the PMO. I am on a PMO buy signal. It is sort of turning down, but with what we've been seeing in the market, I'm not overly surprised about that. Possible flag. And it looks okay. We still have some room to grow, but this $20 range looks really tight. So I don't think that I would be going for this one. So I'm going to go back. Let's look at Medallion Financial, MFIN. Now this has a much more interesting PMO and a much more interesting setup as far as the EMAs. This is suited for my trading style. So I'm going to look at this one. And I will go ahead and annotate this. And then we can go ahead and get into the 10 and 10. All right. so I'll start with our auto support and resistance line right there. It's pretty clear. We had this right here. I think you could make a case for a double bottom, possibly. I might look at it as a solid line chart to make sure. This would be the execution of that double bottom because that's your confirmation line right there, popped up above. And I'm looking as far as support and resistance. Let's go ahead and put one up here now too. So we have quite an interesting setup here. This would be a little concerning because it is very low volume, meaning high volatility. So if you're not comfortable with that, you should keep that in mind. And honestly, I think for my more intermediate term investments, I prefer not to have something overly volatile. But that's just the idea of what we do here. And what did we have left here too? I didn't do the scooter. So MSCI. And this one looks great as far as the PMO. It's getting overbought. But look at that beautiful little breakout there. Again, the EMAs look exactly the way I want them to look. You can see that we had this ascending triangle here that we broke out of just as expected. So this one looks pretty good. And I have to remember to sort it because that's what we didn't do. And Nexio. And look at that flag. PMO's on a buy signal. It is decelerating, but look, it's because we're forming that flag. So that wouldn't bother me too much, especially when I'm looking at a scooter with that height. And then you can see with OBV, these two tops the second one's a little bit higher than the previous one. And if you look at what happened here, the price tops are in decline. So that's a positive divergence. So this one looks pretty interesting. But like I said, just be aware of the volume so you understand the volatility. And of course, the lower price stocks usually are going to end up with quite a bit of volatility there. And that was what I was looking at for drilling down. And here's our summary slide on what we have done. And I know that I started with that 3-month sector summary, and then I checked the seasonality, which led me to XLF. I went into those industry groups, selected specialty finance because that was at the top, and then we looked at the stocks based on scooter value. And there you go.
Yep. And as far as, my style, I like to focus primarily because I am a believer that we're still in a bull market. So I really want to try and focus on the aggressive areas of the market. So that's going to be technology, consumer discretionary, industrials, and financials. Today, I focused on consumer discretionary and kind of looked down through the various industry groups, saw that gambling stocks seem to be returning to favor in terms of relative performance recently. And so within gambling area, those were 5 individual stocks that I took a look at that I think definitely have some merit as we go forward. Some more than others, some are a little riskier than others. So it kind of depends on your overall desire for risk and what kind of returns you're trying to get in the market. But really good presentation. I think that the drilling down fit perfectly on the heels of what Bill Shelby talked about with the market carpets, because that's another way to simply drill down. So we showed you going from the sector summaries how you can do it. Bill was showing you from market carpets how you can see from those heat maps which areas of the market are leading over various time frames. So a couple of different ways, but very useful ways to check out relative strength and so forth in the market.
All righty. Well, let's see. I'm going to grab the screen back here, get to what I need to, so we can get ready for that 10 and 10. And you do know Twitter is your first symbol.
Ready to go.
All right. I keep ending up in the wrong place. Here we go. All right. So these are the 10 and 10 symbols. It looks like I got 2 more. I'm just going to add them really quickly. And that was MCD and Verizon. So McDonald's and Verizon. That's how you can easily add them. So here's what we've got as far as our 10 and 10. We had a lot of requests today. 32 is a bit higher than normal. So let's go ahead and we're going to look at it in our RG form so we can see what the rotation looks like amongst these stocks. And there's our update. I'm going to fit it so that we can see a little bit more. And because there are so many, it is a little bit busy here. But you can see there are quite a few here in that improving category. But what we really want to see, this isn't a lagging category, but it's heading straight up into improving in that northeast direction. So that would be an interesting one to look at. Mule here, we can see is turned back up. It was weakening, but it's starting to show some strength. And relatively, it looks strong in comparison to the S&P, which is your center line here. So let's get to it. I'm going to look at what our most popular request was in the chat room. So you still have time while Tom's doing Twitter. But hit like on any of those symbols you like, and most popular one will be next.
Sounds good. Let's get into it. Here's Twitter. Twitter, like I said earlier, I spent some time talking about Twitter relative to Facebook. So I am a much bigger fan of Twitter than I am Facebook for sure. And Twitter has been right at the top of the scooter rank for quite some time. And sometimes weakness in other areas. I mean, you never know where the weakness is going to come from. But in this case, I think Facebook is creating some nice value in some of these other internet stocks. I think Twitter fits that bill. First key area of support in my mind is after we had the earnings report with the massive volume, over 150 million shares back here in the second week of February. We gapped up, came back down, and we did not close back below $30 as we started rising again over the next 3 days after earnings. And you can see the volume, even though it was off of that 150 million, it was still very heavy volume back to the upside. So I think Twitter was trading in that range. We moved up a little bit beyond, had maybe a little lesser volume, as you can see, negative divergence. And so we're pulling back, but notice that 50-day moving average is creeping up closer and closer to 30. We got great support there. I think I mentioned earlier on the weekly chart, the rising 20-week moving average is down at 27 and change. So it's possible we could get down to the bottom, but I think this 27 to 30 area is a massive area of support for Twitter. I don't know that we'll go down below the 50-day moving average. If we do, it could create some additional opportunities to accumulate. I like Twitter. I think that this is presenting an opportunity. This weakness is presenting an opportunity here.
All righty. So let's see. What's our next one? It's going to be the most popular currently in the chat room. And that looks like, well, it's actually a tie between Facebook and Snap. So since we've looked at Facebook, I think a lot already today, let's do Snap.
All right. Snap. This one I have to, full disclosure, I continue to trade it. I think that off of this uptrend, what I was talking about earlier was a potential wedge. I think that wedge is still in play here. So I'm going to just draw the wedge in what I'm looking at, which is the low. Not exactly a perfect line there, but I think if you drag that down, you will see that we have these lower lows, and then up here are the lower highs. And you can see off of this clear advance with earnings, we have been in now what I consider to be about a 7-8 week bullish wedge. And I suspect we're going to break to the upside. I feel a little bit better. The fact that we're breaking this prior low, you can see that the volume is just kind of so-so. I mean, we've traded 16 million shares today. But again, with earnings, we traded over 200 million. So on a relative basis, I think the volume still is fairly light. I think if we hit this trend line, we're going to get a bounce. Didn't quite get there earlier today. I'm actually waiting to add on Snap, and it's probably going to coincide with a reversing candle. I would love to see a test of this line and then maybe print a hammer. On that type of a candle, I would be back in with the rest of my shares.
All righty. Let's see. Let's make the next one PayPal.
All right, PYPL. I like the chart still. I think that we're continuing to consolidate off the gap down that we saw with the overall market. Made our way almost all the way back up to fill the gap. Didn't quite get there. But we do continue to put in higher highs and higher lows. So, I mean, we could check these higher highs if you wanted and higher lows. So I think the uptrend remains intact. The key areas obviously are going to be both gap resistance and price resistance, which reside up about 85 and a quarter or so. And then the recent low, I would be watching here down around 72. So it's a pretty wide range, but this is a fairly volatile stock. I actually expect it's going to hold these moving averages. So you got a little bit, maybe going back over the last month, there's this little trend line. We could probably highlight that. right here. So you got a little bit of a short-term trend line in play. I think if you break much below 80, 79 and a half, then I think it starts to raise the possibility or increase the odds that we're going to make another push to the downside to either test the recent low at around 76 or maybe even all the way down to 72. Although I'm still looking for bullish resolution, so I don't think we'll go back down there. But short term, I'd watch this trend line.
All right. Let's see. How about Halliburton, HAL?
Yeah, I'm actually looking for the energy space to start to pick things up a little bit. And Halliburton is another stock that I think is at a pretty critical area of both price support and with a positive divergence in play. You can see that we've been moving just a little bit below what I consider to be a pretty key area of support that had been holding up until just recently. But the thing that gives me some hope here, and we do need to get a reversing candle in play, but as we this low here on the PPO versus these lows, can't tell if it's turned up, but there's no doubt that since we had these new recent lows, that this PPO is now turning higher. So I think that this is setting up potentially for a really nice trade on Halliburton. I just don't know if it's put in that final. I'd like to see a capitulatory almost bottom, but as you can see, the failures recently are at the declining 20-day moving average. So right here is one, right here is one. So to the downside, while we're establishing positive divergence, to the upside, what we want to see is a break above the 20. That would likely lead to a 50-day test. So I'm starting to turn a little bit more bullish with Halliburton and with energy in general, but we need to see, I'd like to see maybe a false breakdown and a reversing candle print.
Okay. How about XOM?
Sticking with energy.
Mm-hmm. I think
this is a big part of the XLE. So if you like the XLE, you need to like ExxonMobil. Here, I think is very similar to Halliburton. I think we got a great positive divergence in play. Volume on the selling over the past week or so has not been huge, in my opinion. It's actually moderated somewhat. So here is your lower low coming down. And actually, I could even extend this. Let's go back to here. And you can see the lower lows in price and clearly the higher PPO readings. So I think we've got an established positive divergence here. Maybe we put one more tail in below this 73 low. I'm looking for maybe a trip back to test that reaction high at around 79. And at the same time, you can see that that was a big support level here. We broke down below that support level on heavy volume. We failed here with a reversing candle, bearish engulfing, printed the positive divergence. I think we could run back up to 79 or thereabouts to test the reaction high and also to reset this PPO at the center line and also to test perhaps this declining 50-day moving average. So I think that that energy is kind of, I don't know, maybe getting close to being sold out if it's not already. And Exxon would certainly support that. And with it being such a large component of the XLE, you do want to see some bullish indications start to appear here. And I think we're beginning to see some on Exxon.
All right. How about Mazor Robotics, MZOR?
All right, MZOR. Oh, well, the volume here, I mean, I would have expected that 20-day to hold. I don't know if there was news out, but very heavy volume the last 2 days, losing the 20-day moving average. So now I think it's going to bring that prior low into play. To the upside, I would be watching the 20-day moving average. We've had many, you can see with this gap up on heavy volume, very similar to what we saw with Twitter. I was just showing heavy volume gap up, and when we came down and we held that, as you go out here, you can see intraday moves below, but we haven't closed below $58. Now that we're back below this 20-day moving average, though, I do think this potentially could set up for another test of that 58 level. In the meantime, I think we want to pay very close attention to this now declining 20-day moving average because we lost it with heavy volume. And to the downside, we want to keep an eye on that support level. So from a trading perspective, I don't think there's much of a trade here at this point, but as we get closer to 58, my reward to risk will turn much more in favor of being long.
All right. Next one is Mule. And
I know Mule,
MuleSoft, yeah.
it was having a really, really strong day. But let's pull this one up.
Yeah, it's up over 20%.
Yeah, there's no way I never will jump into a stock that's up 20%, or rarely. I mean, it would have to be a massive long-term consolidation where we're seeing a gap up where I expect that we're just going to see a huge move to the upside. That's not really the case here. I mean, in fact, the stock was $22 about 6-7 weeks ago. And with today's high being at 42, it's nearly doubled in 6 weeks. So I just think it's gone up too fast, too far, too fast. So I'm not interested in trading at the current price. I wouldn't short it. I mean, anything that's moving up like this, there's no way I would short it. But as far as going long, I think the breakout here is down closer to 34, 34 and a half. And I think maybe over the course of the next couple of weeks, if things settle down, maybe we can get it back down closer to that level. So I like the stock. I just don't like, I think there's too much risk to jump in at this point.
All right. One here that I feel lukewarm about, RH. PMO's starting to look good, but wow, you can't even hold for me, the 200-day EMA is presenting problems.
Yeah, let me pull up a weekly and see what the weekly looks like here. Yeah, negative divergence. Actually, it's coming down testing. This is exactly what I would expect off a negative divergence. So if I was going to trade it, I'd probably keep a very tight stop. But you can see right there, we got up to this level at about 75, pulled back, kind of came all the way back up, maybe a little bit of a cup handle, broke out. I'd like to have seen more volume on that breakout. But as we got up to the 105 level, notice when we got back to 105 that second time here, the weekly PPO had rolled over, 20-week moving average failed to hold, and now we're going all the way back down to test this area of support just below $75. And that's where the rising 50-week moving average sits. And we're also getting this center line reset on the PPO. So it's a mixed bag. The selling has, taken place on fairly light volume, light to average. So I could still make some arguments here. I think if you close much below 72, 73, I would be concerned. But if you're looking at this from a longer term perspective, I think you could give it a little bit of room below the 50-day and maybe look at it as a longer term, intermediate term trade with a target back up that 105 level, and that could set up a pretty nice reward to risk. So I think I've kind of talked myself in from an intermediate term perspective to being a little bit bullish.
Isn't that how it works sometimes?
Yeah, I mean, sometimes you look at that daily chart and don't want a part of it, and then you take a look at the bigger term, bigger picture weekly chart, and it's a different story to be told. And I think it's always a good idea to take a look and kind of take a step back. Because if you're looking at an hourly chart, you kind of get caught up in the emotion. And then you look at the daily chart, and it may look a little different. Same thing with the daily and the weekly. Sometimes it's better to take just take a step back and look at it more from a longer term perspective.
Right. And then, generally I kind of do that just on my own investments because I generally plan to hold them for a little while. So, okay. The next one I have is Interactive Brokers Group, IBKR. And even though I'm on a PMO sell signal, I'm sure the PPO does the same. It looks like it's in a bullish confirmation of this rising trend.
Yeah, I mean, it's continuing to trend higher and higher. I'm going to do this one under the relative chart, and I get this question once in a while to show my relative chart. So I'm just going to pull down to the settings here so you can see how I set everything up. Down here on the bottom under price, it's symbol, dollar symbol, colon, dollar industry. And then the next one is price dollar symbol, colon, dollar SPX. And then down finally on the bottom, here's dollar industry, colon, dollar SPX. Okay, so that's how I set this relative chart up. I think it's a good way to get a lot of information on one chart. The IBKR is continuing to move higher. This is the investment services that I talked about earlier that I like. There is, I think, a negative divergence on the weekly chart, I think, from what I recall. So that may be, maybe adding just a little bit of a bearish flavor in the near term, especially if we fail to hold breakout levels like this level right in here, trying to get back up above that. But overall, I mean, this is a stock that's doing very well relative to its peers and doing very well relative to the S&P, and its industry group is doing very well relative to the S&P 500. So I have no problems with this stock. I think we just came up and held on to, I'm going to annotate this from a price perspective, but we just held on to the price breakout here, broke out, came back, tested that level, and also tested that rising 20-week moving average, 20-day moving average, and starting to turn higher. So I don't really see anything bad on this particular chart. You've got a strong stock within a strong industry.
Yep. All right, that's it. 10.
Oh, that was 10? I thought we had one more.
So
I can tell you in 1 second. I only have 9 annotated.
all right, I've got Twitter, Snap, XOM, PayPal, Halliburton, Mazor, Mule, RH, IBKR, and AAXN.
Oh, AXN, I don't think I've done.
Oh, okay, the 10th one. I got ahead of myself. I was looking at the chart. So, didn't you see it?
No, I didn't, as a matter of fact. Let's see. All right, AAXN. This is actually one that John Hopkins mentioned when he was on here the other day. I mean, I love the chart. I'd like to see just a little bit more selling. But let's see. The rising 20-day is one area that I would look to trade this stock off of. If it fails to hold that, then I think you got the rising likelihood that maybe we would go all the way back down to the top of gap support right here. But there was a lot of volume coming in on this stock after it gapped up with earnings right here. I mean, when you look back over the chart, I love it when you see this kind of volume. There is no mistaking that there was a lot of accumulation taking place on that news. It opened up at 32 from a prior close, 27 and change, and it traded up to 40 the day after earnings. So this was a huge move on very heavy volume. Market makers were having problems stopping the demand to the upside here. So when I get a pullback on a stock like this, I get much more excited. I mean, this is one that I would probably put in the top 10 or 15% of all my strong earnings chart list, simply because of the reaction that it saw after earnings. So I'm waiting. We're starting to get a little bit of a pullback with lesser volume, but maybe we can get it a little closer to the 20-day moving average. I like AXN.
All right, perfect. And that completes our 10 and 10 to 1. And we're running low, so let's get it moving right now. I'm going to talk briefly about our upcoming ChartCon. Let me get there. Okay, so stock charts slash ChartCon is where you're going to find this information. We're having a virtual conference in August, and everybody here should be attending. It is very similar to the way we do this show, only you're going to actually see us standing on the stage and presenting. So you'll get to actually see what we look like a little bit more than just those same pictures. So reducing risk is what we're doing. And, you know, if you do want to come in person, we do up until March 31st, we're selling the VIP packages. So this one is to just be a part of the ChartCon weekend with us and enjoy all of our company. And if you really want to add a little summer vacation on the top of that, I think it's a great deal because you get to bring your significant other, and it's a cruise. And most of us will be going on it. So there's going to be group dinners. You're going to find us all over the ship. You know, you can talk to us, whatever. So I just wanted to bring that up, especially these VIP packages, because like I said, we're not going to be selling them after March 31st. We got to get all the information into the hotels and especially the cruise company. So as you can see, we've got great speakers, great topics, all pretty much centered around reducing your risk. So highly recommend you go check that out. And now I'm going to go ahead and take us to the market update. And here we go. So what's been going on currently in the markets? Let's look at the candle glance very quickly. As you can see, we did have a nice price rise here on the Dow as well as the other major indexes on the open, but they've really been consolidating sideways since that. I think the good news is that we're seeing these all on the positive side. The Russell 2000, in fact, has also moved back up and onto the positive side. Barely, but it has. We can see that Treasury yields did rise in the morning, and now they are consolidating sideways, currently 2.881. We have UUP, a gap up, pulled back, but it is now starting up to new intraday highs for the dollar. Commodities are up today. We hit that intraday high, and then boy, it just dropped, but it's staying on that support of the earlier intraday low. So I don't think we're going to have too many problems here. And you can see USO, similar setup. The only thing I'd be a little worried about at this point is that intraday reverse flag. And that could execute and bring prices back and take back some of those gains we've already seen in USO today. Gold is down, not a surprise when you see that the dollar is up. They have an inverse relationship. Gap down, tried to make a recovery, but is heading back down again. Currently, GLD 124.30, and the VIX is mostly unchanged, reading right around 19, which is, elevated, but not overly elevated, especially when you look at where it was yesterday. So we have pulled back on that fear factor, as they call it. Let's go very quickly to our member homepage. I'm going to just take a look right now at our top scooter movers. And first of all, here are the top scooter ranks for the large cap stocks. And I'm going to go look and top up who are the big movers right now. So we're seeing Sinopec, nice little gap up there. And again, you can just hover over these. Dover Corp, wow, big bar up, but it looks like it's hitting some of that overhead resistance at about 105. We'll have to see if it can pop up above that. I even see a double bottom there set up in March that is now executed. So should be interesting. And that's it for our final market update. And with that, I think, do you want me to get started on those sector rotation, or would you like to do that?
I'm ready and set up. So
all right, go for it.
I just have really 2 charts I want to show. So,
okay, perfect. And then I'll go on in.
All right. So let's take a look first. I'm going to show you, I'm going to go into my blog because I put a chart in my blog today. And so I think the best thing to do is just start with that. And it's under the current outlook. And I looked at relative ratios. So when I was looking at different groups relative to one another, I try to evaluate the strength of the move of the S&P 500, the sustainability of a move in the S&P 500. So here you can look back over a 1-year chart and you can see the S&P obviously made this huge move into January. And now we've been coming through, with this consolidation. We've been seeing this consolidation now for a period of time, which is actually necessary. I mean, we needed some selling. We needed a period of consolidation to kind of unwind the overbought oscillators. We kept talking about how overbought the market was. We needed this. If you look at the XLY, XLP, I featured a few relative ratios where the first symbol is the aggressive part of the relationship, and the second symbol is the defensive part of the relationship. And so anytime you're in a bull market, one of the necessary ingredients is you want to see an appetite for risk. You want traders to be in a risk-on environment. That is what sustains bull markets. So anytime I see the S&P going up, I like to see the XLY versus the XLP going up as well. And even through the downtrend, we've seen traders willing to take on more risk within consumer discretionary versus the more defensive consumer staple. So I think that looks great. Transports versus utilities should also rise when the S&P 500 is rising. And you can see that heading into year end and into the very early part of 2018, we had a huge rise in transports versus utilities. Clearly, you don't see a rise like this unless traders believe the economic picture down the road is going to be stronger than it is today. That's why you would want to be in transports and why you would want to get out of utilities. And so we had that beautiful move. Russell 2000 versus the S&P actually had gone down most of 2017, but has started to rise recently. Now, you might look at it and say, well, traders didn't want to get into the more aggressive Russell 2000, but I think a lot of that had to do with the declining dollar in 2017. So I think if the dollar has truly bottomed, it did bottom back at the end of January. If it truly has bottomed and we're moving higher, I expect to see this relative strength on the Russell continue higher. Finally, banks versus REITs in a strong environment, the economy improving, you want to see banks outperforming. I think they've been doing that. So when I look at the market, I really, underneath the surface, don't see the issues. Yes, the market is volatile. Yes, we've been seeing big declines. I think it is consolidation after a pretty big move to the upside. And I think eventually we're going to resolve to the upside. The other chart I wanted to show you is simply 2007, looking at the exact same setup. Here was the S&P 500 making its final high Here's the XLY versus XLP rolling over. It had topped several months before. The transports versus utilities were already threatening a major breakdown. They had topped several months before. The Russell 2000 was struggling versus the S&P 500. That was clear several months before. And then finally, banks, which were fine on a relative basis until about 2 months before the S&P 500 topped, and you can see that that was moving. When I look at all of this, I see two completely different pictures. 2007, we had a lot of money rotating toward defense. In 2018, we still have money rotating toward offense. So my belief is based on sector rotation and some of these different charts I've looked at. I think it supports a correction much more than it does a bear market. And so when you wonder why I'm still looking at stocks to go on the long side, it's because my anticipation is that prices are going to go higher, and I want to be in on the long side.
Absolutely. All right, I'm going to go ahead and share my screen. I wanted to show a graphic first about sector rotation. We always talk about it, and I need a picture to illustrate what's going on. And to me, when I hear rotation, I think of a big circle. Now, we have various images on the Stock Charts website in Chart School. I'll put this one in the Market Watchers Live blog because I don't think it's on there, but I really like these sort of rotation so you can see through the economic cycles. And as we were saying, you know, you have your defensive areas and you have your more aggressive areas. And so you look at which way are we going. And again, so financials, technology, you're going to see these all in that early cycle, discretionary. But when you start to go down, we're starting to see in the late cycle, telecom. So we're still not as much, we're seeing technology, but in a different version here. Healthcare is going to start doing well, staples. Now we're in that defensive mode, utilities. Those are the ones you're going to expect. And then we're going to look for financials to start doing well, technology, et cetera, and just a big round circle. I also wanted to show you a new thing that I'm going to be including in my Decision Point blog now and then, and that is our Decision Point sector scoreboard. You're already probably familiar with the Decision Point scoreboards for the 4 major indexes, but I think this one is a great visual so you can see where our trend models are from the intermediate to longer term perspective. And, you know, as you can see, the only ones with problems are, you know, those defensive sectors pretty much. I think the real estate sector is getting hurt by the rising interest rates. We've got utilities are doing very poorly, and you can see especially poorly when you have the long-term trend model also on a sell. And down here it explains how you get to these various signals. So I thought that was very interesting when you're looking at our Decision Point trend models in the intermediate and long term. It does still look strong, Tom. I mean, we're still seeing those stronger sectors doing really well. And I just wanted to go look at one more thing. And we were in the sector summary, but I wanted to look at something a bit different here. And I'm pretty sure, yep. So I'm going to come down here. I wanted to look at this in Candle Glance. And actually, I'm going to take it over here because I want to use the Candle Glance that I have for my personal account. And I'm going to look at these in Candle Glance. So this is, you know, similar. We can see all of them at once. And the reason I'm doing this is because I do know which sectors are the stronger ones, but I want to see momentum shifts. And this was something somebody had mentioned in the chat room. You know, if it comes up on your 3-month rotation, you know, how do you know it's going to do well the next 3 months? And as I said, if I knew that, I'd not be doing the show. I'd be on an island somewhere. But you know what you do, this is the way you can do it, is look at the PMO. And I think we were talking about it. Energy is in a very interesting place. I just got a PMO buy signal on it. And, you know, see, energy is supposed to pick up a little bit here too when we want to come out of a correction or a move that way. So I like the setup. You know, there's still some issues. You know, the volume on the OBV is still trending lower, not great. Scooter is okay, not great, but it shouldn't be. You know, we've had a really rough time here, and now we've been consolidating. So I would be watching this zone very carefully and look for a breakout possibly here. But we need to get over that 200-day EMA, because if we don't, the 50 is going to cross below the 200. I'm going to have a long-term sell signal. And that's what I had for the sector rotation. And here you go. Yep. Our summary chart.
Yeah, I think, there's a number of different ways to approach it. And really, that's kind of the theme of our show today. Bill Shelby kicked it off talking about how we can look at rotation using the market carpet. If you came in late, I would suggest that you go to YouTube and search stock charts and go to our stock charts page. We do keep recordings of all of our prior shows on YouTube. So if you're ever wondering, when you look at our page with our show, we keep the last day's show. But if you want to go back beyond that, you can go to YouTube and you can pull up those prior shows. But I thought Bill did a great job explaining how you can use market carpets to identify and really kind of drill down, which was the segment we did earlier as well. But using market carpets to drill down to find some tradable, actionable ideas. And, Aaron, you were just going through and showing that rotation, the cycles, and pulling up using the PMOs, how they're showing relative to some of the other PMOs in the various groups. I took a look at some of my favorite ratios and how they compare today versus how they compared back in 2007. I'm not seeing any similarities at all. And I'm not saying that I expect every bear market to be exactly the same. They all set up differently. 2000 to 2002, we had issues with many of those small, they became very big technology companies, but they had no revenues, no earnings. Of course, we remember the dot-com bubble. And then, of course, the last bear market was more financial driven. It was the near collapse of our financial system. So every bear market sets up different. But the one thing that tends to be somewhat similar is that if we're going to go lower, it doesn't just happen. I mean, bear markets you don't just wake up in early February like we did in 2018 and all of a sudden we're in a bear market. I mean, it normally is a process. You go through a process where factories start to slow down. Maybe it's interest rates are on the rise. Maybe we have inflationary pressures, but there's a jockeying underneath the surface of the market between many of these sectors. And I'm not seeing it. I just don't see traders, smart money moving toward defensive areas of the market. And so without that, I mean, if we do start this bear market from here, they're going to get me for sure, because I just don't see the start of a bear market coming.
No, I agree. I think we're in the middle of a correction. I would like to see my indicators start to turn back up, because I'd like this thing to be over. But what I think we could watch is that energy sector, because generally that sector starts to pick up as we're getting ready to go into another, rising trend in the overall market. So it'll be interesting to watch what happens there.
Yeah. And I think, too, when we talk about the energy picking up, it should lead. It's not just, the fact that it goes up and maybe takes out a key resistance level, that sort of thing. It's when energy actually begins to lead the S&P 500 to the upside. And I mean, we could go back and take a look at the chart, but energy topped on a relative basis, relative to the S&P 500. Energy actually topped back in 2008, and it has been on a decline ever since. So I don't see us yet into that cycle where energy is leading. I agree with you. I think when we start seeing money moving into energy and we start seeing money moving into consumer staples and some other more defensive areas, telecommunication stocks, I think you mentioned, those are warning signs. And personally, I'm just not seeing much of that at the present time.
No, I agree. And really, as you said, you don't wake up and it's a bear market. This sector summary, looking at that, and your relatives charts are outstanding. And you showed, it already starts to come in. You already will start seeing those signs earlier when you start seeing the weakness in some of these, leading sectors and some of those relative ratios. So I learned some stuff today too.
Well, I tell you, every time Bill Shelby and Chip and Grayson come on, I learned something new. And I know, Chip used to do his regular webinar, and that was what he always liked to hear somebody say is, at the end of his presentation, he wanted to get feedback that, hey, I didn't know stock charts could do that. And I think every time we get those folks on to take a look at and do everything stock charts, I think that's probably what most people walk away with.
Yep. So the rest of this week, we have David Keller, CMT. He's going to be here tomorrow. He was the managing director, I think the manager of research over at Fidelity for quite a few years. So I think it'll be very interesting to talk to him. We have your workshop coming up on Friday, Reasons to Sell. And I know we get that question quite often in our survey and in the chat room. So that should be really, really helpful.
Yeah, that's always the hardest part. And even to this day, sometimes I have to, everybody, it's kind of a learned trait, I guess, as you grow up. You don't want to lose money.
Right.
And I said before, I've been into some of these more psychological classes, because I think it is important that you kind of get over some of the psychological hurdles when you have to trade. But yeah, that's something that I think everybody struggles with, when to trade. If you're a short-term trader, you got to follow your principles. If you're more of a long-term buy and holder, you still have to have certain things that you look at in terms of selling. So it'll be an interesting workshop coming this Friday, no doubt. All right. Well, I think that is it. That brings us to the end of another great show. I want to thank everybody for being with us today. Please remember to complete that survey as you exit. Let us know what you think of the market carpets. We haven't talked about that here on the show. And Bill spent 15, 20 minutes with a great presentation. So we'd love to know what you thought about that. And, of course, what you think about Market Watchers Live in general. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here tomorrow on Wednesday. Happy trading.